are the reason for all of your success, and you are the reason for all of your failure. Full stop. How can you lead a team if you can't lead yourself? If your life depended on whatever it is that you're doing today, right? Would you go about it differently? Did you leave it all out there? Because anything worth doing is worth doing right.
I've got this right. I'm maybe just doing it wrong. That's the bigger, greater definition of focus for me. If you're the most determined person, but you have no idea what you're doing, hard to succeed. If you're the most focused, but you give up easily, what's the point? So to me, focus includes getting rid of the noise.
Good morning. Friday, last Friday of June. Today refi day, or was yesterday refi day? Let's see, 27, 28. No, yesterday was refi day. So I guess we are done for the month on refis, but not purchases. Turn our attention to July. Slow start with a holiday week coming up. Sort of rally continues in bonds. Let's see here. Give or take, really right around yesterday morning's levels. If I do a 2-day at 9:05 yesterday, we were literally identical to where we sit right now. Been a little choppy. Trading, generally speaking, in a super tight range. Notwithstanding, say, pre 9 o'clock yesterday, fives traded within like a 3-tick range. 5.5s maybe breaking out slightly here. One could argue we're a tick or two above best levels yesterday, but again, a super tight range. Less so, maybe a 4-tick range. Sixes really right in line with when rate sheets struck yesterday, and 6.5s lagging. 6.5s are underperforming the rest of the stack. And sometimes and this is a difficult proposition, but sometimes I try to read into intercoupon activity, and for that matter, even fannies versus ginnies and spreads to treasuries. And, you try to read a little bit into, okay, what's going on here? Why aren't we rallying across the stack, or why are we, or, why are 6.5s? Because if you look at 6.5s, by the way, and one were to pull let's call it a 3-month chart. Call it April 9th-ish through May 17th-ish, a solid 30, 45-day period. 6.5s, we're kind of feeling it, right? And, over that same, 3-month chart, you look at it, and we talked about this. I mean, we're still 150 basis points worse than the best levels that we've seen on 6.5s. You go back to 6.5s, middle of March, we're better than we were on 6.5s. But you go to April, and we're, almost 100 basis points worse. So, sort of what's going on, right? And, I think in a real simple way, where I think 6.5s are holding out a little bit is it would seem to me that the longer run prognosis for interest rates is arguably a bit more optimistic. I think that you don't want to necessarily find yourself stuck in 6.5 coupon production that might see slightly higher speeds. So long story short, there is, I feel like just on the surface, when I look at how some of these coupons are trading, there might be some longer run optimism about about rates in the bond market. As far as this week is concerned, I found yesterday's Fed speak, and let me see if I could bring it up here, because I always sort of like to talk about directly what they said. There was some conflict. Yeah, so John Williams talked about the fact that inflation is still too high, and that the current rate policy is well positioned to lower price pressures. So, you got to listen to that, and I think part of the reason why we kind of got through yesterday and got through some of that Fed speak. And by the way, Goolsbee talked about persistent heat in the economy and that inflation is stubbornly high. But then there was, and I don't see it here in this quote, but there was some dovishness in what Goolsbee said. Trying to think what the language was. Anyway, the two Fed speeches yesterday, net, I think were reasonably bond friendly. I think the admission of some heat behind the inflation is obviously bond unfriendly, but then the follow up of, hey, I think we're well positioned. Now, one has to extrapolate, what does well positioned mean? Are we well positioned as we're sitting here, or are we well positioned because we think we're going to hike once, twice, three times, whatever the supposition of these hikes are going to be? I'd like to interpret that more around where we sit here today. I'm going to see if I can dive into what Goolsbee said, because there was something in there that to me was pretty bond friendly. So let's see here. Chicago Fed Reserve said that inflation is still trending the wrong way, though there have been a few bright spots. I could swear that he talked about oil. Market expects the Fed could cut rates in September. I don't know where the heck that's coming from, by the way. This is an old article. No, June 25th. But Goolsbee wouldn't comment on where he stood. Austin Goolsbee said on Thursday that inflation is still trending the wrong way, although there have been a few bright spots. A little later in the afternoon, John Williams said he expects inflation readings to start trending lower. So all in line with what we've been talking about, right? They're kind of front running the decline in the price of oil. He said that he remains squarely focused on inflation, and I believe both talked more about inflation than unemployment. You've seen now a little bit of improvement on the services inflation, and we've been talking a lot about that, the manufacturing versus servicing prices. And I've been identifying that as something we would want to see. Very bond-friendly statement, right? But right now, as between the two sides of the Fed's mandate, the inflation side and the job market side, clearly the problem's on the inflation side. So let's sort of unpack that for a second, right? And not to beat a dead horse here, but because we're trying to look forward, not behind, not as we sit here. All right, if they're more concerned about inflation than they are about jobs, right? And they believe that inflation is the bigger problem than jobs because there's been some softening in jobs. To whatever extent that the inflation is transitory vis-a-vis oil prices and Iran, once we solve that, or once that problem resolves, one could extrapolate that we return to a more accommodative Fed. I'm not saying an accommodative Fed, but one that's not hawkish, one that's not looking at restriction. So all of this, both on the surface and beneath the surface, is dovish. It's bond friendly. Comments came hours after the Commerce Department reported core inflation, blah, blah, blah. Price increases were fairly evenly distributed. Goods rising 0.4, services up 0.5, most since January. Don't love that. On the good side, much of the gain was driven by energy, which jumped 6.5%. And that's why we have to see, and they have to be convinced that oil and gas prices are going to fall. And they are falling. Now, to contradict what they said earlier in the article, market expects that the Fed could raise its rates. We're talking about a rate cut. But he wouldn't comment on where he stood, said he's applauded Warsh's move to discourage forward guidance. Let's streamline. Let's take some forward guidance out of there. Let's not speculate on rate path. I think it's healthy. He dispelled the notion that there's rancor within the Fed. Williams sees reason for hope. Said he expects inflation readings to start trending lower. He's happy with interest rates at their current levels. Again, almost all of this is bond friendly. Given the elevated levels of inflation, it's imperative that we restore it to our longer run goal on a sustained basis. Current stance is well positioned to do that. Inflation, he said, will drop to 3.5 this year from its current 4.1. To continue on a glide path back down to 2. Like the World Cup tournament, the economy can take a surprising and unpredictable turn. One thing that's certain is an unwavering commitment to support maximum employment and bring inflation down. So, you can understand why 10's kind of opened at 439 here and why we've kind of held this rally. And this often happens. And what did I say about that Fed decision? I thought that it wasn't as hawkish. I said that the market was offside, and here we are. Here we are at 439, helped by some other things, helped by some reports, helped by the end of the conflict. By the way, both of which were predictable to a reasonable extent, helped by maybe some month-end, quarter-end stuff. If we look at the markets overnight, stocks in Asia mostly down. Nikkei giving back basically all of last night's or whatever Thursday night's, Wednesday night's gains. Yeah. Europe also mostly down. Futures here, NASDAQ indicating down a point. Everything else flat-ish, slightly down. Volatility, the VIX is up 5.5. Not certain I fully understand that, but more on that in a moment. There was some activity overnight in Iran and some peaceful missiles. I mean, there's no other way to put it, I guess, right? Oil prices down, and that's again where I say all of this stuff is starting to become a bit disconnected, by the way, and I find that to be interesting. Currency, US dollar up almost across the board, but not quite. A little more split overnight. But crude and Brent down about 3%. Crude back under 70 and Brent approaching. We're at 73. And I want to say, I feel like those are the best levels that we have seen. Let me pull a 1-month chart. Yeah, we are absolutely sitting at, a couple pennies aside. I mean, we hit a low of 72.47. We're at 73.09. But for all intents and purposes, we are at the best levels that we've seen, March 1st, right? So where do we have to go? I mean, we hit 60 on January 2nd, give or take low of the year, a little below 50 might have been, right? Yeah, 59 and change sometime in January. So there's room to go here. But I mean, when you consider peakish was like 331 at a 118.35 close. I mean, gosh, we're more than 50 off, round numbers, 50% off worst levels. So I think that there's a lot to be optimistic about. I know a couple of weeks ago, well, it's probably more than a couple of weeks ago, when we had that bad run of data, I was sort of really getting pessimistic about rates. But what I would say is, if we judge June at the moment, and it's not over, on a whole, I think that you really have to like, if you want lower rates, right? I think you really have to like where this data has headed, right? It's a great start. I think that you have to love where we are with the conflict, notwithstanding anything, and let me just talk about what happened in Iran. 45 minutes ago, Iran reasserts its right to control shipping in the Strait. Don't love that. But there's some conflict. U.S.-Iran agree to set up a direct channel with IRGC. But then 2 hours ago, Tehran strikes ship in the Strait. So it's still complicated, but you have to like where we're headed there, right? You've got to love where we're headed with the price of gas and oil. And I think that you've got to be encouraged. I don't know love, but maybe love where the last couple of inflation prints. I mean, we were headed to the moon, and we've kind of reversed that in a big way. I mean, didn't we have a 0.9 either PPI or CPI print, for a monthly? And so to go from 0.9, which would be what, almost 10% annualized, to start printing, 0.2, 0.3, 0.4, which is, call it 3-ish% annualized. Got to feel really good about that. So how do we play out the rest of the month? We've got sentiment at 10. Williams talks again in cash carry mid to late this morning. So I think that's the big news of the day. We're going to want to hear what they have to say. I wouldn't expect anything new out of Williams, by the way. Michigan sentiment, I don't know. Anecdotally, this is a meaningless report. In reality, it's incredibly meaningful. But just, I feel like how we digest it and how it's maybe presented, for me, takes the shine off the sensibility of it. How we feel is how we act. So consumer confidence, Michigan sentiment, in theory, should be more important, right? And in some ways are more topical than the Q1 GDP report that we just got, right? I mean, it was somewhere between 3 and 6 months ago. Who cares, right? But somebody who, a couple of weeks ago said, hey, I feel great, or I feel terrible, they've yet to spend potentially. Or more importantly, I would think we'd be more concerned about what they're about to spend or not spend than what they just spent, right? But what I hate about this report is that so often the questions and the surveys and now you're being asked to speak about stuff that, maybe you have no business speaking about, or the emotion of it. Your stocks, stocks were down 3% yesterday. So all of a sudden, it's like, I just feel terrible, right? Like, well, I don't know. And understanding, we've talked about this, how we digest economic information. I'm up 100% on the year, but I lost 10% this month. So I think I'm down 10%. No, you're not, right? And that's tricky in business. Listening to the last person who spoke, incredibly sort of defective way of running a business. And I think that some of these surveys sort of play on that. The last emotion you felt is what you sort of spit out on the survey. But I suppose that I'm more concerned about consumer sentiment than the headline than I am about inflation expectations. One would think if there's going to be a beat there, meaning good for bonds, so maybe it's a miss. I don't know. It's always weird how I guess it would be a miss. Beat bond wise. It might be an inflation, people feeling better about prices. So how do we close out this week, go gently into the end of June? It really just more of the same. I think, as I said yesterday, when you look at a chart, I think 5.5s and up are kind of like a full-on lock event. I think 5s at this point are pretty darn close to a full-on lock event. And but on the 5 and maybe 5.5 coupon, if you wanted to take on some risk, just play it day by day. If you decided to float yesterday, keeping an eye on things, knowing that there was no data this morning, but before rate sheets would ultimately get printed, more than likely some print post 10:30, then you know what? You didn't hurt yourself. I don't know that you helped yourself. I don't believe you're going to see rate sheets at better levels today than yesterday. Maybe. If I pull a 2-day here, it's really a mixed bag. We could, on 5s, you could be anywhere from 2 ticks better to 3 ticks worse, depending on where a lender might strike yesterday versus today. If it was absolute worst yesterday and absolute better today, maybe there's 5 ticks, maybe. And I would say if you see that, right, if you see 10, 15, 20 basis points better on 5.25 to 5 5/8, possibly even 6 1/8, it's hard for me to not want to encourage you to take that. I can tell you here, we've been very tight in our coverage the last few days. In fact, even short on a few coupons. I just think that discretion is the better part of valor. We've had a really, really, really nice bounce back. You talk about 97.13 on 5s on May 19th. Call it a month ago. I know it's more like 5 weeks. So 97.13 with potentially no end in sight. We had no idea where we were going from there, right? And here we are 150 basis points almost better. Rome wasn't built in a day, notwithstanding everything I just said about the fact that I thought that Fed speak yesterday was dovish. I think that the market is coming off the hawkishness coming out of that meeting, maybe seeing a lot of what I saw that day when I said that we were offside. So when I give you kind of my probabilities, listen, I feel 80% good here, right? I feel like this plan of, hey guys, wait until July, August, right? I'm becoming more and more optimistic about next week's data, by the way, right? But what's really to win here? It's hard for me to envision a scenario whereby, so if I take February and before out, we've got maybe 3/4 of a point in rally on 5s. That's sort of our best case scenario. So the question you have to ask yourself in your lock float consideration is holding out for another 75 basis points worth me risking 150? And generally speaking, the math would say no. You want to win big and lose small. And at 97.13, when we went basically full on float, right? The proposition was we can win big and lose small here. And so, all of these lock considerations, the month of July, to me, you're 70, 80, 90% lock right here today. Not because I don't think that the ground is fertile for lower rates. I just don't think that the payoff is worth it. But to whatever extent you do, take it day by day and don't chase your losers. Real quick, if you have any questions or you have anything that you want to say, please post them. Otherwise, Thanks for joining live. Thanks for the hundreds of you that watch on replay. Join us one morning. Would love to have you. And remember, bulls and bears make money, pigs get slaughtered. Choo choo.